Have you ever wondered when is the best time to invest in penny stocks? Let's start by understanding what penny stocks are. In simple terms, they're shares of companies that trade for less than $5. But don't let their low price fool you. These investments can be like a roller coaster ride, high risk, but also high reward. Penny stocks aren't for everyone. They're most suitable for investors who can tolerate the risk and volatility. And one of the most critical factors in this game? Timing. You see, penny stocks often dance to their own rhythm, separate from blue-chip stocks in the broader market. They can soar one moment and crash the next. That's why timing is crucial when investing in penny stocks. Understanding when to enter and when to exit can make the difference between a successful investment and a costly mistake. So, let's dive into some key moments to consider when investing in penny stocks. Firstly, it's important to understand that penny stocks often follow market cycles. Now, what are market cycles, you ask? Think of them as the ebb and flow of the stock market. They're basically patterns that the market tends to follow over time. There are three key phases to grasp: the bull market, the bear market, and the consolidation period. During a bull market, everything's coming up roses. Stocks are on the rise, and optimism is in the air. This might seem like the perfect time to invest in penny stocks, but remember, what goes up must come down. Then there's the bear market. Here, stocks are falling and pessimism reigns. But even in a bear market, there can be opportunities for the discerning investor. Finally, we have the consolidation period. This is when the market is in transition, neither bullish nor bearish. It's a time of uncertainty, but also potential. So, paying attention to the overall market sentiment is crucial when considering investing in penny stocks. Now that you understand market cycles, let's talk about timing your investment in penny stocks. Timing, as they say, is everything, and this adage holds especially true in the world of penny stocks. But don't be misled. The goal isn't to time the market perfectly, to buy at the absolute bottom and sell at the absolute top. That's a fool's errand. No one can predict the market with pinpoint accuracy. Rather, the aim is to understand the right conditions for investing in penny stocks. Let's break it down. Penny stocks, due to their volatile nature, can offer substantial returns during a bull market. Why is that? In a bull market, investor sentiment is positive. People are willing to take on more risk in hopes of higher returns. This optimism can lead to increased demand for penny stocks, pushing prices up and creating potential opportunities for investors. However, it's not just during bull markets that penny stocks can shine. Periods of consolidation can also present excellent opportunities. Consolidation is a phase where the market moves sideways, with prices neither significantly rising nor falling. During such periods, penny stocks can provide an avenue for growth that may not be available with more established stocks. The key here is to identify penny stocks with strong fundamentals and potential for growth and be patient. But remember, while these can be the best times to invest, they can also be the most risky. The volatility of penny stocks means that prices can fall just as quickly as they rise. Therefore, it's crucial to have a well-thought-out investing strategy and risk management plan in place before you dive in. So, when it comes to investing in penny stocks, you don't need a crystal ball. What you do need is a solid understanding of market cycles, the ability to identify the right conditions, and the patience to wait for these conditions to materialize. It's not about predicting the future, but about making informed decisions based on the present. Remember, timing is everything when it comes to investing in penny stocks. Let's quickly recap what we've discussed today. We dive deep into the world of penny stocks, those tantalizing prospects that sell for less than $5 a share. We've learned that they're not for the faint-hearted, given their high-risk, high-reward nature. We then navigated the choppy waters of market cycles. Whether it's the bullish uptrend, the bearish downtrend, or the sideways shuffle of consolidation, understanding these cycles can provide crucial insights into when to invest in penny stocks. And finally, we've emphasized the importance of timing. It's not just about what you invest in, but when you invest. Timing can be the difference between a modest profit and a spectacular gain, or, conversely, a painful loss. Remember, investing in penny stocks can be risky but rewarding if you understand the market and time your investments wisely. Good luck with your penny stock investments.